Folks, what I'm going to do is this. I'm going to minimize the chat box. I am talking. This is live. I'm here. This is not a pre-recorded class, but I want to really teach you something very cool today. And I want to really explain the markets from a perspective you've never seen before. And for me to do that, I really need your attention. So what I'm going to do is I'm going to minimize the chat box, and you guys can ask me. I'll finish a few minutes early, and you guys can ask me any questions you want, and I'll get through it. It's just I have so much exciting stuff today. I don't want to get caught on a different, I don't want to go on a different route. So let me do it right now. Let's start, and we'll go from there, okay? Thank you. All right, that's me. We're going to talk about identifying monstrous 1,453% breakouts before they strike. My name is Roger Scott. I'm a retired hedge fund trader. I've been managing money for many years. I've traded stocks, options, futures, and Forex, and I'm the head trader for Wealth Press. And please visit us. Now, today's topic is how to identify 1,453% breakouts before anyone spots them. I need to do some housekeeping. Let's go through this disclaimer very quickly. We're not financial advisors. We're not broker-dealers. This is designed to teach you, to educate you. Everything I'm going to show you today has statistical back testing. None of it is based on what I think, what anybody thinks. But past performance does not equate to future results. Everything we discuss that happened in the past may not happen in the future. And most importantly, take this from me. I've been doing this for many years. If you paper trade, all right? Paper trading is like riding a bike. You can't read how to ride a bike. You can't learn how to ride a bike by reading about it. You got to do it. Otherwise, you're good. There's a emotional response that needs to be triggered. So paper trading is really good for learning about the strategy, how the strategy works, the propensity of the strategy. But you're not going to learn about a strategy by paper trading. The only way you'll understand strategy is by taking it, trading it, and working it and seeing how it makes you feel and controlling your emotions. So paper trading is really good for learning things, but it's not really good for actually doing it. If you want to learn to trade, start with a small account and build it up. Let's begin. So in the next hour, you'll discover how to find stocks and options before they explode, not after, before any indicator identifies them, before big money on Wall Street begins targeting, before, not after. Anyone can do it after. We want to do it beforehand. Check this out. Entry price on a stock, 7-day hold, 30% gain. Entry 17th of March. Breakout happens 19th of March. By the time we get on a profit target, we are already at a break even or loss if we get on a breakout. If we enter before, we make 30% before anyone finds it, before anyone sees it, before it's on anyone's radar, all right? Look at this one. We enter on the 22nd of April, all right? Very easily, the breakout happens on May 6th, May 7th. By the time profit comes, boom, there's nothing left on the table. You're left with taking a very small percent, maybe 4%. But if you started without the breakout, you'd be up 34% in 21 days. That's what we're talking about. That's what I'm trying to get to today. And again, the overriding theme today is how to trade like a hedge fund, what sparks stocks for big gains, and how to find them before nobody else does, and using back-tested data to do so. So imagine if you can identify stocks before the big price occurs, before anyone spots them, all right? That's what we're going to talk about today. Now, 54% in 28 days. Notice when the breakout happens. Notice when we enter the stock. We entered the stock, 54% gain, 28 days, when nobody was paying attention. Again, the trend began, but by the time the stock broke out, it was too late. I've always wanted to figure this out. This has been always a big driving force. What drives the price of the stock before the big move begins, before the big price rises, before anyone looks at it? Because afterwards, anyone can do it, right? It's in Bloomberg. It's on Wall Street Journal. It's in Investors Business Daily. It's on CNBC. Everybody's an Einstein after the big move occurs, right? But what if you can do it beforehand? Look at NVIDIA. NVIDIA was the darling of 2018. It was the number one, number two stock. It was going back and forth with Amazon in terms of relative strength. That's a 50-day moving average. Price breaks out. Everybody watches the 50-day breakouts. And the gap, classic buy signal, right? You enter the next day after a high on a breakout. You do what every classic trader does. but your profit potential is greatly reduced because look at where you're buying it. It's too late. That was the high. So Charles Schwab's breaks out on the triangle pattern, okay? Simple triangle pattern. It looks very solid. It's a flat top triangle. It's a very high risk trade, but look at what happens a week later. The gains are erased. They're completely erased. So what's the fun in that, right? So there's a major downside to price breakouts because they only work roughly 30% of the time. Now, I know you're thinking to yourself, no, he's wrong. The market's been going up for the last 2, 3, 4 years. No, let me be very straight with you, okay? The stock market is not a trending market, all right? It's a counter-trending market. So if you looked at the stock market over time, you would find that it trades roughly 25 to 30% of the time. The rest of the time, it does nothing. And that's based on statistics. It's not based on my theories or what I think or my opinions. That's not worth anything, all right? Data, hardcore data. That tells us everything. So stocks are range-bound 70% of the time. That means they're doing nothing. Absolutely nothing. They're just sitting there, all right? Waiting. So what happens is this. You buy a breakout, you get stopped out. You buy a breakout, you get stopped out. You buy a breakout, you get stopped out. I am sure most of you, if not all of you, who are sitting there right now, reading and watching this and listening to me, or not reading, but looking at this, are thinking to themselves, he's absolutely right. This is typical. This is what happens unless something is really trending really strongly, and then it's too late. So majority of retail traders buy near the breakout level. 90% of traders buy near the breakout level. Only 7 days later, the stock plummets. Now, imagine for a minute, all right? Imagine for a minute that you can buy this stock not at 180, but at 160 long before it breaks out. If you could do that, you'd be golden, right? Even if the stock took a downturn like it's doing right now, you would still be sitting pretty because you bought at 160. You didn't buy all the way up where all the retail traders are buying. You bought at a lower price, but there's a problem with that. So let's back up. Major advantage to buying early. Capture bigger piece of the price movement. Get ahead of the big move. Not competing with technical traders. Your risk level is substantially lower, right? Really good stuff, right? I mean, everybody wants to buy early. But if it was that easy, nobody would be buying breakouts, right? Option traders, they would undervalue options because by the time the option value gets all the way up to the breakout point, volatility is so high, it's just amazing, right? So if you're buying cheap, if you're buying before the breakout, you're buying low, and then you're selling high overvalued options instead of selling overvalued options and then buying them back. So it's a completely different way to trade, and it's very different than most retail traders trade because majority of retail traders still trade breakouts. So here's the big problem, and this is what I was getting to about 30 seconds ago. Here's the big problem. Unless you know when price will rise, it makes no sense to buy early because you're just a buy and hold investor, right? I mean, if you don't know when you're caught, it's like a catch-22 situation. You buy on a breakout, you buy when the price is rising, and then your accuracy is about 30%, or you wait till the market, settles down, you buy when it's congesting, and then you wait. And then you become a buy and hold investor. It makes no sense. So one way you have more risk. The other way you have more time where you don't know what's going to happen. And if you're trading options when the markets are congesting, you're putting yourself in a terrible position. Just a terrible position because that option is going to decay fast. So what did I decide to do? I come from a hedge fund background. I had statistical data available to me. I had people who tested systems all the time. 2 of my guys worked for us. They worked for me. They were MIT grads. So I went on a quest to find what drives price before the big breakout occurs, before the momentum comes in, before price action starts to move. I really wanted to discover it. I wanted to find what really drives all this? How can I get to the bottom of it? How can I start doing exactly that? Not wasting my time, but buying before the breakout. So here's what I did. I went on a quest. I literally went on this is me, Sherlock Holmes, okay? I went on a quest to find how did the most popular investment and trading strategies compare to the S&P 500 over the past 20 years, all right? Because I wanted to make sure that I wasn't looking for that magical unicorn, for something that didn't exist. I wanted to see, maybe I was missing something. I needed a flatline base, all right? So I needed to create a base. I needed to see what other systems out there. I'm thinking, I've been doing my own thing for many, many years. Maybe I'm just not seeing things. Maybe I need to go back to the drawing board. So I wanted to go back. I wanted to see what I could find, all right? And folks, this is exciting stuff. I mean, this will save you so much time. If you don't buy anything from me, please, please, please absorb this, okay? This is stuff you can't get anywhere else. No one's going to share this with you. And I truly mean that, okay? And unfortunately, some of what you may see, you may not like, but unfortunately, this is the truth. Remember I said the S&P is a counter trend market? Well, if you were to go back to 1999, all right, and again, when I say I do statistical back tests, I don't test 6 months. I don't test 4 months, 3 months, 2 months. I go back 20 years, all right? 20 years, sometimes 30 years. I go back all the way, all right? Because I want to see everything, the big picture. Sadly, the S&P 500 gave us 5.998 return, almost 6% return annually over the last 20 years. Nothing to really write home about, right? Not even close. 207%. I mean, it's okay, right? It's all right, but it's not very sexy. So here's what I did. We're just trying to get a baseline here. Our baseline, 5.98%. We want to see exactly what we can get. And if you were to look at the commodity market, all right, for example, let me just back up here. If you were to look at a commodity market like currencies like the Japanese yen, which I believe still to this date is the best trending market in the world, you would see some years 60%, 80%, because the commodities and currencies are a trending market. Stocks are counter trending markets, okay? If they were trending markets, then they would trend more than 30% of the time statistically, and they would generate more than 5.98% return a year over 20 years. So they're counter trending markets. So what did I do? I decided to take 34 strategies, 17 fundamental, 17 technical, all right? Again, I started with a clean slate. My criteria, remember, we want to be objective. We want this to be like a scientific experiment, okay? So I took the most popular and well-known strategies. I objectively programmed into the computer, and then I wanted to confirm. So because these were really popular, well-known strategies, they're sold by other services, they're easy to find program. I wanted to be as objective as possible. So I wanted to confirm that they were as close in line with the statistical accuracy of what they're known for. So I wanted to make sure that I wasn't just, again, going on a different road. And we'll do the fundamentals first, and then we'll do the technicals, all right? And again, and this data is a few weeks old. It may not be up to date yesterday, but again, we're going back to 1999. It's pretty accurate. So, give it a couple of weeks or maybe a month from now. But this is about as accurate as it gets, all right? So we took the S&P 500. We took Martin's Wig. We took T. Rowe Price, Drummond, William O'Neill, Top EPS, Neff, Buffett, Lynch, you name it. I'm sure most of you guys know these guys, all right, or have heard of them. We got Dogs of the Dow, even Foolish Small Cap 8, Peter Lynch. Everybody's here. These are the fundamentals, all right? These are the fundamentals. Let's see. Which one? Buffett, I believe. Yeah, I think Buffett took it. Buffett was at 17.2%. No, I stand to be corrected. William O'Neill took it, the guy who publishes Investors Business Daily and who wrote the book How to Make Money in Stocks, one of the best books out there. William O'Neill, 18.8%. the Can Slim. I'm sure most of you guys remember the Can Slim system. That's William O'Neill. So, and that's very objective. They published that system. It's easy to code, 18.8%. A lot better than 5.98%, right? A lot better, but we're not even close. So now we get to the good, this is my specialty, the technical stuff. So again, if you're a technical trader, if you've traded any kind of technical strategies, then you probably know all of this, all right? Moving average crossover, modified RSI, channel breakout, momentum trigger, Bollinger Fade, stochastics pop, MACD divergence, modified RSI pullback, ATO. If these are all classic technical analysis systems, okay? These are not systems that were around. Most of these have been around for 30 years, okay? And the best one was the modified RSI, and the only modification I made was I took the standard 14 days and I changed it to 10 days. And then it was just buying overbought and selling oversold. Buying oversold and selling overbought. So anyways, let's continue with this. So as you can see, the numbers were a little bit better. The modified RSI gave us 22.4%. It was a solid strategy. 5.98% from the S&P 500, 18.8%, something like that from Buffett. We're getting better. We're getting better. No question about it. We're getting better. All right. But we're nowhere near where I really want it to be. All right. Because if we're able to predict breakouts before they happen, we should be a lot better. All right. So just as I was saying, the modified RSI won 22.4%, almost 4 times better than the S&P 500. Nothing to sneeze at, right? Nothing to sneeze at. Very solid numbers. And the RSI is one of my favorite oscillators. I love it. But this just wasn't going to do it for me, okay? I didn't spend 25 years in the stock market to make 22.4% return. Not even close. So I didn't want that. That wasn't going to do it for me. I wanted 45 to 50% return. And remember, keep something in mind. Keep this in mind. This isn't compounding, and we're not even talking about options yet. If you can get 50% return a year on the underlying, the numbers that you can get on the options will blow your mind away. And we'll get into that in a minute too. But let's continue this. So just imagine for a second what 45 to 50% return annually is, all right? In 5 years, I did the numbers for you to save you some time, but the numbers are staggering, all right? In 5 years, $10,000 becomes $115,000, more than 11 times on your money by simply compounding. 11 times. I mean, think about what we'll do for your family, your kids, your college, anything you need, you'll be able to afford with a 45 to 50% annual return. Those are some hefty numbers, okay? Those are some serious numbers, especially if you can do it year after year, continuously over time. And I showed you the best fundamental systems. I showed you the best technical systems, and we weren't even close, right? We were at 18.5 or 18.8 and 22 point something. So we weren't even close. So I needed to go back to the drawing board. I had my baseline. I had my best of the best, but it just wasn't good enough. So I had to answer two very, very, very important questions. Folks, pay attention. This is life-changing, what I'm going to show you. I'm not kidding here. This is life-changing. 2 important questions. What types of stocks experience the biggest gains? And what's the best trigger for explosive price moves? If we can answer those 2 questions, we're going to get a lot further, all right? Just keep those questions in mind as I go through this, okay? Because it's going to lay it all out for you, all right? I'm not here to make you play a guessing game. I'm going to teach you everything, but I need you to understand where I'm coming from. So what types of stocks experience the biggest gains? Small caps. Small caps consistently outperform large caps because it takes so much more volume to drive a massive price of a stock, 13 million shares a day, rather than 1 or 2 million shares a day. They're not saturated. They're not bloated. These companies haven't experienced massive growth. And again, when I talk about small caps, I'm not talking about over-the-counter stocks, penny stocks, companies that just went public. That's not what I'm talking about. I'm talking about smaller stocks. I'm talking about stocks that are just not part of the S&P 500 yet. I'm talking about stocks like stocks in the Russell 2000, stocks that are about to become blue chip stocks, about to be getting coverage from large investment firms. but have not seen it yet. But I'm talking about stocks that are valued at $1 billion, $2 billion, $3 billion, market cap of a couple of $1 billion, huge companies, but not companies that are saturated, not the Amazon yet, okay? Amazon 30 years ago, 25, not 30, 25 years ago. Netflix 20 years ago. But let's continue. It's going to get interesting. So I did some number crunching, all right? And I did this for several quarters, but I did it a quarter at a time. You'll have to take my word for a few of these facts, but here's just a real simple, to give you a very, very big idea of how the difference is. Top gainers in the S&P 500, 43%. That's the top gainers over one quarter. And I did this over about 25 quarters, and the low end was about 35. The high end was about 55. The average was 43.72. That was really the average. So that's the quarter I used. And then we went to the Russell. And again, I took about maybe between 18 and 22 snapshots. And it always was in the triple digits, anywhere from 200% to 400%. So I figured this is a good example, 285%, 6.5 times. So if you're putting your money in smaller stocks, all right, if you're putting your money in smaller stocks, you can gain over 6.5 times as much upside. And we're not even talking about options yet, all right? We're not even talking about options. So that's the first part of the puzzle. Remember, we had 2 questions, right? What's type of stock experienced the biggest gain? And so we already know smaller stocks, not tiny stocks, smaller stocks, stocks that haven't become or haven't taken prime time stage yet, but stocks that are getting ready to do so. Stocks that are getting ready to be the next Microsoft, the next Netflix, the next Tesla, not the ones that are in prime time now. So we know that already. We know that the average profit potential on a smaller stock compared to a larger stock is 6.5 times. So remember that. Again, if you don't buy anything here, if we never talk again, if you never hear my name again, remember 6.5 times higher profit potential on smaller stocks than larger stocks. And that's just simple statistics and math. This is not my theory. Nothing here is based on my theory. So let's get to the number 2 question, the fun question. I can't wait for you to see this. What's the best trigger? What's the best trigger for explosive price moves? We already know the stocks are going to be smaller stocks, but what's the biggest trigger, right? So let's go. I'm going to back into this question. What's the strongest catalyst for triggering intense directional momentum in the price of a stock? In other words, that's a fancy way of saying what triggers the biggest move in a stock. So let's get to it. And I'm going to have you guys help me answer this question because it's a good question. Tesla is one of the fastest growing companies, public companies. It's one of the darlings of Wall Street since 2010, right? It has gained over 3,000% in the last, In the last 4 years, 5 years, 6 years? Since it went public, so let's say 9 years. 3,000%. That sure beats 5.98% from that you get from the S&P 500, but we'll get into that in a bit. 3,000% gain. That's crazy. So the stock must be making money hand over fist, right? The stock must be just killing it. I mean, it must be outperforming every quarter, right? How can it not, right? Oh, look at this. Again, this is not my theory. The stock hasn't made any money. Tesla has not made a net profit. So you're thinking to yourself, at least I'm thinking to myself, how is the stock up 3,000% without making any money? Explain it to me. Can you imagine you and I starting a company, all of a sudden we go public and we're up 3,000%, but we're not. Where's the money? Where's the beef, right? It must be a coincidence, right? I mean, it's because it's Tesla, because people like Musk, because, you know, he's in the news all the time, because they make pretty cars. It must be a one-time thing, right? So why is Tesla up 3,000% while it hasn't made a net profit? Explain it to me, because I can't understand it, but we'll get to all of this. Another coincidence, another aberration? I don't know. You tell me. Zillow. It's up over 5,000% since going public. Not 3,000, 5,000. So obviously this company must be just banking. Money must be, I mean, it's got to be the best stock, the most profitable company, right? It's got to be, right? I mean, it has to be. Well, let's look. Negative, 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 negative. Folks, I'm not making these numbers up. Okay, net income, negative, 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 negative. Why is Zillow, and Zillow's doesn't have a famous CEO, okay? I don't even know the guy's name. But why is Zillow stock up over 5,000%, and the company hasn't made a dime in net profit? I mean, explain this to me, because this really stumbled me, right? I was doing all this analysis. I'm looking all of these different creative ways to outperform my 18%, my 22%, my 5.98%. So here's these stocks. They're going up. They're not making any money. I'm confused. Here's the reason why. Investors believe that at some point in the future, we don't know when, but in the future, Tesla and Zillow and companies like it will be worth substantially more money. Their current value, their present value, is entirely based on expectations. In other words, it's a complete house of cards, and Wall Street loves it. And there's really no other way to explain it, because they're not making any money. They're not putting any money on the table. It's all investor capital. There's no net profits. I showed you. If you don't believe me, look at the K10 yourself. It's all there. Their present value is based on future expectations. Disney makes more money than God. I mean, Disney makes so much money, it's ridiculous, okay? And their stock hasn't gone anywhere in years because their expectations and what they're valued at are close together. They're aligned with each other. Where these stocks, investors believe that at some point something will happen. So it's a difference between present value and expectations. And the bigger the difference, the higher the price of the stock will continue moving. If you don't believe me, then look at Zillow and look at Tesla. It speaks for itself. So what did 20 years of data tell us? Investors don't pay any attention to what already happened. Markets always look ahead, and they largely discount everything that's known. And the big moves in speculation occur of what could happen, not present facts. Anything that's known is priced into the stock. There's just no two way about it. And that's what we learned from 20 years of doing all of these tests. But it gets better and better and better. So I purposely left out the best performer. I held out. I got it. I'm guilty of holding out on you, because one of my tests didn't give me 22.4% like the modified RSI did. It gave me 49.14%, over 8 times the return of the S&P 500. Now, everybody can do it 1 year, 2 years, 3 years, 4 years, 5 years, maybe even 6 years, maybe even 7 years. If you're really lucky, maybe even 9 years. But how about outperforming the market and having a 49.14% annualized average return over 20 years? How does that sound? So if you invested $10,000 in the S&P 500, in the end, it'd be worth $30,777. That's including the $10,000. And if you invested in my top strategy, your average annual return of 49.14% can grow $10,000 into over $19 million in less than 20 years. $30,000 or $19 million from $10,000. Now that's real money, and that's life-changing. And that's why I'm so excited, because it's easy to do it in 1 year or 2 years or 3 years or 4 years or 5 years, but doing it for 20 years is tough. So that's what we did. And these are some of the trades. Let me show you. I'll get deeper into what we did, but let me just show you some of these trades. SunPower, 59% in the price of the stock, 14 days, no prior notice. Notice the breakout occurred on February 14th. We got in on the 11th. If you got in at the breakout, you'd hardly realize any profit. We realized 59% return in the price of the stock. 59% in 14 days. The option, remember what I told you? If you can get 49% a year on stocks, the things you can do with the option are mind-blowing. 430%. If you guys want a better life, 430% option gains will give it to you. I can promise you that. That's massive. That's 2 weeks, not even a month. 14 days. Momentum indicators, they wouldn't catch the trade 3 days after entry. By the time the momentum indicator caught it, by the time it was on everybody's radar, by the time hedge funds were looking at it, by the time everybody got into the trade, it was over. It gained maybe 15%, and that's if you were lucky. And the option was probably so overvalued at that time that you probably would have lost money on a real strong volatility crush. And anybody who's traded options knows exactly what happens when you buy options on a breakout. Volatility crush. Education, career education, notice when we got in, November 7th, no notice, no volatility, no breakout. 48% start till the 9th, all right? And then when the price rallied, we got out. If you waited a day or two, all of your gains would have been erased. Option, 325% in 28 days. Again, if you bought the option after the breakout around the 10th of November, it would have been way too late. It would have been way, way too late. Technical indicators wouldn't catch this trade till 2 days after entry. And by that time, about 2/3 of your, if you were trading options, 2/3 of your gains were gone. It's a totally different way to analyze price action. No technical indicators and no fundamental projections. Completely different. And this is what I've been holding out on, okay? I wanted you guys to wait and see earnings revisions, but not the way you guys think, not the way newspapers do earnings revisions, a totally different way. But earnings revisions was the biggest catalyst to explosive price moves without any prior notice. All right? So let's get into it a little deeper. Earnings estimate drive price. Financial analyst firms provide actual dollar value or a price range. In other words, they give you the expectations. How quickly price reaches that level depends on the credibility of the firm and how much influence they have in the business. So it's not, oh, okay, earnings is how we do it. No. It's a lot more complicated than that. So if you only focus on positive earning revisions, you will wind up with a massive disaster. If it was that easy, everyone would be doing it. You need to match the right number of positive revisions from key investment firms. You got to make sure there's a lack of negative earnings revisions. There's proprietary earnings and momentum filters, all right? Because if you do it just by looking at newspapers, if you use just a homemade approach, it's going to get messy. We took computer systems. We built algorithms. We took every major company and saw what they did over the past 20 years, what influence they had on each stock. And some worked and some didn't. And the ones don't work, it's messy. For example, IBM and Barclays Bank. It really is like water and oil. Folks, again, if you want to learn something from here, don't ever listen to Barclays Bank with IBM. They always pick the worst times. They can't help themselves. And this is so much better, this kind of data, because you have so many data points. It's like using weather conditions or almanacs for futures and commodities, except you're using it for stocks. Because if you can take 80, 100, 200 revisions from each company, you have so much data to work with. And that's what we did. We built a database. So again, you can't just look at any investment firm and any stock. The stock and the firm have to match. There has to be a nexus between them. All right. So it's important to know which investment firm has the propensity to drastically move the price of the stock. This is very, very important. If you don't know which investment firm drives that stock or which investment firm specializes in a specific sector, you're putting yourself in harm's way. The investment firm that gives the revision, all the difference in the world, all right? There's 4,700 analysts out there, and each one specializes in only a few sectors or industries. And if the right group of analysts upgrade the stock, you can see massive massive price appreciation. And I'm talking big price appreciation. Look at Overstock. This is a big stock. Everybody knows this. But again, it's not an S&P 500 stock. So we call it a smaller stock. 34% in 21 days after entry, no prior notice, no breakout, nothing at all driving it. Options, 328% after entry. Can you imagine, again, I've been doing this forever, but making 328% in just a few days, 21 days and 3 weeks, that's amazing, all right? Momentum indicator signaled 10 days later. 10 days later, it was over. And that's if you're trading the underlying. If you're trading the stock, forget about it. Chemet Corp, 35% in 29 days after entry. Again, no prior notice, all right? The option, 327%. 327%, folks, in less than 1 month. Momentum indicators caught less than 40% of that gain. You didn't hold very long, but you only caught about 40% of that. 40%. That's not good. That's not how you're going to reach 49% return annually if you're trading the underlying, or amazing numbers if you're trading the options. So the name of this program is Billionaire Breakout. So it's a computerized trading model. It analyzes a basket of stocks to see which analyst firm influenced the price with their recommendation. We include the number of positive revisions, the number of analysts standing behind the coverage, their core specialty, and their track record. It targets small caps and mid cap stocks. And again, we don't target over-the-counter stocks. We don't target tiny penny stocks. We target stocks that have the potential to move, that are sitting on the sidelines, growing, that are becoming bigger companies, and finally institutional momentum is starting to put light on these companies, and they begin to move. If you take if you take a 100,000 share position in Microsoft or Amazon, it'll just suck it up. But if you take that position in a smaller stock, you will see a bigger gain. So when you see institutional volume beginning to expose itself to that stock, you'll see price come in very quickly. This is a perfect example of what I'm talking about. A Medicis Corp, not a tiny company, not a huge company, but a very good company to trade this way. 34%, 21 days, no prior notice. Not even close. Imagine getting in on the 30th. If you traded that option would be probably twice as expensive on the 30th than it would be on the 11th when you exited. I'm not kidding you. So it doesn't work. It just doesn't work. But traders continue doing the same thing and expecting different results. The options gained 255% during the same 21-day time period. All right? So keep in mind, they're not bloated, oversaturated companies that already made their fortune. These are huge companies. These are not huge companies. Huge companies have to see continuous buying pressure. These don't. Imagine hitting a nail 20 times into a nail gently, and then imagine hitting it hard once. That's the difference. If you hit it, these large companies, they're used to seeing exposure over and over. They're immune to it. They're too big. Their float, that's what it's called. Their float is too big. But small caps are raw. They have that power. They have that ability to still move. They don't have a huge float. They're not over bloated. All right? And this is a perfect example. I was trying to explain it to somebody and who didn't understand the stock market. And I said, imagine throwing a bowling ball, and imagine throwing a tennis ball. It's really that different. It's really that different. It makes all the difference in the world, okay? So if you can get it right on a smaller stock, your gain opportunity is 6.5 times higher. And if you can get in before breakout, oh God, the difference is just amazing. The things that you can see are just amazing. So no penny stocks, no startups, no speculative companies, public companies ready for massive growth. The average value of a company is between 2 to 9 billion. So these are not small over-the-counter companies. The average market cap is $1 billion. So these companies are ready for prime time. Billionaire breakout methodology will help you diversify. Folks, again, what I'm about to teach you is very, very important. If we never see each other again, if we never talk to each other again, if you never hear my name again, please listen to what I'm telling you. This is crucial information, all right? This is very important, and this is all statistics. Small cap stocks are substantially less correlated to the overall market. Correlation is the relationship between two assets, regardless of what those assets are. Increased diversification can lower your overall account or position risk. Diversification, as they say, is the last free lunch on Wall Street, okay? So here's the problem. You buy a stock, it's a great stock, you did your research, you did your homework, you did everything, you did your due diligence, and then the stock market goes down 1,000 points and your stock goes down. You know why? Because it's correlated to the stock market. Everybody who's listening to me right now is going, yeah, he's right. I've seen that happen all the time. And it works both ways. When it goes up, it goes away. But you know what? If you follow my method, you will not be a slave to the stock market anymore, because you don't have to be, because there's a way to trade uncorrelated assets. Notice these two stocks. This is Delta and United Airlines. All right? Look at them. It's the same thing as buying the same stock. I get phone calls from my clients saying, hey, Roger, I'm listening to you. I'm diversifying. I'm buying two different stocks. Oh, yeah, what stocks are you buying? Delta and United Airlines, or Intel and AMD, two semiconductor stocks. You can't do that. That's ridiculous. That's the same thing as just buying twice as much of the same stock. So you have very low correlation. So you have to be right on the overall market if you're going to be trading large caps. So the threshold, again, please take what I'm saying. This is really important stuff. You need to be mindful of this. If two assets follow each other 2/3 of the time, it means they're highly correlated. And that makes logical sense, right? If you trade highly correlated assets, you increase your risk and you decrease your profit potential, and you increase your risk of loss. And it's very important you understand that. So you don't want to do this. 0.66, that's the magic number. Now look at this. This is the system, the billionaire breakout system, and this is the S&P 500, and this is the last 3 years. Their correlation was 0.26. That's almost negative correlation. That means you will not have any relationship problems trading these two assets. Let me prove it to you. You know, all these numbers, 0.26, 0.66, let me show you something cool. And this is probably going to be the most powerful thing you'll see today. You can't make this stuff up, and no one did. Look at these numbers. Look at these numbers. Look at 2008. The system made 48.77%. Excuse me, sorry, I'm looking at 2007. Look at 2008. The stock market lost 36.73%. The system made 6.34%. Is it a fluke? Look at 2002. The system lost, the S&P lost 21.58%. The system made 35%. Look at 2001, 71.35%. 71 imagine trading options. But look at 2016, look at 2017. It outperformed the stock market every year. And the average annual return, 49 something percent, over 49%. The S&P had 4 losing years. We had none. Outperformed the stock market every year for 20 years. And again, if you're trading options, it gets, add a 0 or 2 to every one of your gains. So, and this is, again, please, I'm giving you this information. I want you to have it. I want you to think about everything I'm pointing out to you, because I'm sure you've seen a lot of this stuff. This is not the first time you're seeing it. You probably have thought about this a lot. But everything I'm pointing out today is based on very strong theory, not theory, but actual statistical probabilities. And probabilities is what built Las Vegas, okay? And Las Vegas is growing to become one of the biggest cities in the country, okay? So this is just a simple way to change the odds and become a hedge fund and trade like a hedge fund. You put the odds on your side. You go from, if you go to Las Vegas, the longer you sit at a table, the higher the odds that you will lose your money. If you're a retail trader and you're not trading a system, or if you don't have an edge, it's the exact same thing. This gives you an edge. So 4 periods Not only do stocks only trend 30% of the time, but only 4 periods account for 75% of all movement during the year. So if you're trading large caps, remember I was talking about correlation? If you're trading large caps, this is it. 4 periods is where all the movement is. The rest of the time, nothing. Two-sided market action. And that's a problem. That's a problem, especially if you trade options. So with this, you don't have to wait for earnings season for big price swings. Smaller stocks can move quickly when the right analyst begins coverage or revises earnings. You get opportunity for big moves without having to sit on the sidelines. Nobody wants to sit on the sidelines. Nobody wants to, you start out as a swing trader or active trader or day trader, and then you become an investor when the stock doesn't go somewhere. Nobody wants their hard-earned money sitting on the sidelines. It's not fun, all right? Look at this gain, 22% in 7 days. 22% in 7 days on gain capital. That's the stock, 7 days. Now, the option, 210%. Now, imagine making 210% on your money in 1 week. I mean, that's amazing. That can change your life substantially. That can really buy you a lot of freedom, a lot of opportunity. I could do what I want in my life. I'm a professional trader. I live on a golf course in Florida. I have a beautiful house. I could go on vacation when I want. I want the same thing for you guys. I want the same thing for you. And I've done the legwork. So Billionaire Breakout keeps you in the stock and option that are on the move. We evaluate positions on a weekly basis. We buy options on stocks that are ready to move. If there's no action coming your way, you get out. If price explodes higher, you continue holding. All right? Ubiquity Network, 37% on the underlying asset, 37% in 22 days if you're trading the stock. The options, 746%, 746% in 22 days. The best part, by the time technical indicators caught wind of this, we were days away from taking profit. When everybody was piling in, when everybody was moving their money in, when everybody was going strong, we were taking profit. That's what you want. That's the position you want to be in. So feedback from your peers, from people just like you. And again, these are people just like you. It finds the needle in the haystack before the trend begins. Tom H. I didn't believe it till I saw it. Roy from New Jersey. After 40 years of investing options and spending a fortune on alerts, you finally nailed it. Pete from Oklahoma. The market tanked all week and my options are up 20%. And folks, these are peers just like you. I'm really happy since I started following your advice about a month ago. My accounts have gained 10% in the last month. Aaron from Idaho. Billionaire Breakout. Identify 6 top stocks and the best options to match them on a weekly basis. Find stocks that fit my multi-step algorithm, and we do all the work. This is a spoon-fed system. We give you everything, all right? We review the portfolio every 7 days. You don't have to think about when to buy or sell. Each stock or option gets 7 days to prove itself. If directional momentum doesn't come, it's eliminated. It's that simple. If you're an options trader, again, there's nothing to figure out. All you have to do is place the trade. You get the strike price, expiration date, entry price, exit price. There's nothing else to do. Take a look at a few more examples, and just a few more examples, and I'll start answering your questions. 21% in 21 days. 21 days, 21%. 1,453%. Has anyone made 1,453% in less than a month on a trade? That's real profit. And that's the kind of opportunity I'm giving you today, folks. I want you to join me. I want you to participate and have trades just like this and get over 49% annual return annually. It's very, very possible. It's a complete program. We're limiting it to 50 members. I don't need 1 million people in this program. We open it and then we close it, then we open it and then we close it. I don't need a big rush. This is a very private program. We give a lot of attention to our members. You get 24/7 access to Billionaire Breakout members portal, order entries, and again, we give you the strike price, the expiration date, the limit order. There's nothing to do except place the trade. Every 7 days, you get email and SMS alerts. It's all included. If you like email, you can use email. If you use alerts, you can use alerts. If you live in a different country, it's not a problem. The alerts come several hours before market opens, and it's always Monday, so you always know what to do. There's a getting started guide. You get unlimited email support, and if you send us a question, I'll personally answer it. You get daily updates. You get my daily analysis with coaching. You get a position tracker, which you can download. Everything is completely transparent. There's nothing to do except place the trade. As a bonus, this is something because I love teaching. I love to have my students learn. I created a video tutorial called Capture Triple Digit Winners. It's to help you maximize billionaire breakouts. That's what I'm trying to do, okay? We give you, again, we teach you how we pick the strike prices. We teach you how to figure out if the option is overvalued or not. You don't need to know this for the Billionaire Breakout program. We give you everything, but this is just a bonus. So if you want to learn more, all right? The regular price, $39.97 for 12 months, 49% average annual return. We sell this program out all the time. It's hard to get 1,453% gains with options. This program shows you how to do it, all right? Go to wealthpress.com/billionaire breakouts and learn more, all right? At $14.97, it's the best deal. You get 6 stocks, you get 6 options every Monday, and you get opportunities for big profits. Over 49% average annual return over the last 20 years. And again, we stand behind Billionaire Breakout 100%, all right? Please, folks, visit wealthpress.com/breakouts to learn more. It's real simple, wealthpress.com/breakouts. I know this program will sell out. So if the Billionaire Breakout program does not outperform the S&P 500 over the next 12 months, I'll give you an additional 12 months at no cost. And that's really how confident I am. I stand behind my program. I want to put my money where my mouth is, all right? .com/breakouts. So what do you get? I want you guys to join me. I want you to join me. I want you to be on my team, all right? I want to show you what it's like to make somebody wealthy. I want you guys to see it. This program can help you achieve that. It can really help you achieve that, and I'm not kidding. We've made millionaires, and we're going to do it again. Join me for this program. Billionaire Breakout 1 year, daily coaching's included. That's a $1,000. That's included. Bonus 2, capture triple digit winners, $400 included. Total value, $53.97. You get everything for $14.97 today. And that's the best deal on this program you will ever see. And I really mean that. More feedback from peers just like these are your peers, all right? I'm up $32,000 and I've never made this money in 6 or 7 years of trading, Dan C. Anytime you want to alert me to such lucrative opportunities, please do so. That was just plain amazing. Rena, getting involved with your company has been one of the best decisions. Folks, please visit wealthpress.com. Don't procrastinate. This offer is not going to last. wealthpress.com/breakouts, $14.97 for 12 months. And I believe there's a lifetime offer as well. And let me go ahead and take some questions. Let me just open this chat box here. All right, do we have any questions? And let me put this on the screen here. Yes, please visit www.wealthpress.com/breakouts. All right, do we have any questions? Folks, it's really a great opportunity. And I really think this is going to help you take your trading to a whole new level. I highly recommend it. I highly recommend it. You get the daily coaching and analysis. You get capture triple digit gains, $14.97 for 12 months. Go to wealthpress.com/breakouts. And let me see if there's any questions here. What's the, here we go. It's the same, it's the Catalyst program. What's the percentage of winning trades? The percentage of winning trades is about 65 to 70%. No, we don't have a monthly plan. This is a program. This is a heavy duty program. We sell out of this program. We don't even have a monthly offer for a monthly subscription. But This is a really heavy duty program. This is a one-time offer. We usually sell it for quite a bit more. Take advantage of this opportunity. Enroll in this program. Visit wealthpress.com/breakouts. It's really a great program. And here's the thing. A lot of traders trade stocks, single stocks. You don't want to do that because you're putting all your eggs in one basket. This program allows you to diversify, and it allows you to really, really gain an advantage to trade just like a hedge fund, all right? To trade exactly like a hedge fund. Again, please visit wealthpress.com/breakouts. You could trade options. You could trade the underlying asset. You could trade, yes, and remember, keep in mind, if you're not in the US for some reason, or if you're busy working, you don't need to monitor this during the week. It's a program that's not correlated to the stock market. So if for some reason or another, there's a big downside in the stock market, your correlation's not that high, and that's really, really big. Please reiterate the second year free. If we don't beat the stock market, you get second year free. The 49% gain is based on trading the underlying, Stan. The options I don't even want to, it's insane. The gains on the options are insane. Keep in mind, if you can gain 20% on a stock or 15% on a stock, that's 400 or 500% on the option. So you get 6 per week, and at $14.97, there's 52 weeks a year. You're talking. Let's see, you're going to get that year over 350 signals. You're talking less than $5 per trade. If you have a small account, you could trade this too. Yes, Carrie, you can, because you don't need a big account for these options or small caps. We're not trading Amazon. We're not trading huge stocks. It's a perfect size account, actually. Yeah, you don't need a large account. This is based on the underlying. And once again, this methodology is one of the best ways to trade because you don't have to be stuck to the computer. You don't have correlation to large cap stocks. You don't have the problem of seeing, because nobody wants to be tied to the stock market. Nobody wants to stop. It's almost like you have these 3 stocks. You look at the stock market. Next thing you know, stock market's moving lower, lower, lower. You don't even have to look at your stocks. You know they're going lower. Nobody likes that. Nobody wants that. Nobody enjoys that. The correlation here is 0.26, which means you can have stocks going down all day long and you can have these large caps rising. If that wasn't the case, then we would have losers over 20 years. Every year's a winner. Even the 4 times the S&P 500 lost money. We've made money every time. Yeah, you don't need a large account for this. It trades options, and we give you the limit order. We give you the price. We don't pick, remember, no over-the-counter stocks. We don't give you options that have widespread between the bid and the offer, okay? It's not some options that have $1 spread. We don't do that. We give you a limit order. No, Schaefer does not have a program that does ranking based on earnings revisions. It's actually nothing like it. There's nothing like it out there. This program took me years and years to create, and there's nothing even resembling anything out there. Carrie, I think you'd be okay because you don't need a lot of money for this. You really don't need to spend a lot of money on these options. A lot of them are very cheap. And yes, here's another thing. A lot of folks are looking for big returns with cryptocurrencies, with all these exotic instruments, with Forex. Folks, options can give, believe it or not, options on smaller stocks can give you better returns. 6.5 times better than the stock market, and that's on the stock alone. The options about 25 to 30 times better. The raw gains you can get on the options is just amazing. You don't need a large account. We've had traders starting with $2,500, $10,000. You don't need a large amount. You just don't need a large amount because we could trade options. You could trade with a small account and build it up. As a matter of fact, over the years that I've been doing this, I'm going to tell you, over the years that I've been doing this, I've had the best success with traders who have a small account instead of a large account. $2,500, $5,000, you can build it up. Obviously, if you have a larger account, you can assume less risk, you have less volatility, but honestly, I've seen guys build it up with a small, it just depends on where the market is, where the volatility is, all right? But honestly, it's the best system out there. And if you guys don't want to be correlated to the stock market, if you want to trade options with simplicity, if you want to have easy choice of options every Monday, this is it.